All right, guys. Hello, everyone. This is Keith Bybee with Hurley Investments. I'm your presenter today, filling in for Kevin, who is being a good dad at a birthday party. So he's with his boy. So I am filling in tonight. I wanted to make it pretty short and sweet and to the point. So we're gonna just do a little math on our Baidu trade that we had gotten going. Anyone that has kind of followed this or did that trade originally along with us knows that Baidu had missed pretty much on everything and they tanked. You can see the chart. This isn't where they're at. They're not at 150. They're way down here. You can see this. They finished above 120 yesterday, but they dropped $30. My goodness. So today is going to be about how we're going to adjust for it. So we're just going to do some math. We're going to go over some of the history, just the actual numbers and what we're going to do. So originally we had September bull call trade. Let me just go straight to it. So what you're seeing here is our history, and all I'm going to do is go over the cost basis so we really know exactly what we need our price on our options to get up to get our break even. So originally, if you can kind of see, I'll just go over the total number of amounts, but these here show us the option price amounts. It's easier to calculate everything if you do it in total dollars because these are per share over here, and then divide it down back into per share to get our cost basis. So to give you an idea of what we're doing, so Baidu missed their earnings, they fell. We had a bull call. We had a long call against a short call, 180 long call and a 200 short call. We brought in about $1 on the most recent one. He had done one back in end of April that had a different cost basis. We'll just kind of add it all together, but 842 on the long per share, and then took in a credit of 327 to lower the cost basis there. And then what we did today before the close, and if you're following along, you can certainly do tomorrow, is we basically used the money from these short calls. This one, you can't see it there now, but let me try again. This one and this one, $1.13 and 327 here. And then we went out and bought new calls. These are out to September, so we're sticking with that. And yeah, let's just go over the numbers just so you can see. So, oops, let's forget to get my pointer back. All right, so we have, just a second. Let's add up our long calls. and then subtract that from our short calls. So we had long calls cost us $16.89.03. 3 cents added with another 721. You might have only followed this last one on the 15th, right before earnings, and that's fine too. You'll basically just do the same thing, but not worry about adding the former long calls and shorts. So 721.03 equals, get my little calculator. Plus, that leaves us 2410.06. All right, and then we're going to subtract that number by adding our shorts together. So shorts I assume you guys are hearing me. If I have to ask you to let me know, but if there's not really anything, then I'm just assuming you guys can hear me. So we've got 648.95 plus, write it down before I forget, up here 220.96 are the other shorts. That leaves us with 869.91. So if you subtract our longs here by our short calls here, we're going to equal get back our calculator. 2410.06 minus 869.1, 1540.15. Now something I haven't mentioned is I'm talking about the total of all of the calls. So if you look back up here, there was an original bull call with 2 contracts of long calls and 2 contracts of short calls, and then another position added of 2 long calls, another 2 long calls and 2 short calls with the same strike prices, 180 long calls against 200 short calls. So then a couple of days ago on the 17th, we had closed the short calls for a profit at 15 cents. Since those cost us 15 cents or $65 to close those short calls. And by the way, this was after it fell, right? So 17th, after the earnings came out, they tanked. Then we sold off our short calls on the short side altogether, 4 of them for 15 cents. It cost us 65 cents, but of course, when you come back here and remember that we sold for $8.69, we'll just add that back in. Because we're buying them back. Oops. Plus 65, 7. Got up 15.40 and 15 cents plus 65. Oops. Plus 7. Oh, for heaven's sake. That's better. 1605.22. Actually, I should have minused that. For heaven's sakes. Amateur hour over here. Since it was a credit, and then we bought it back. So we really, net, we got 1475.08. I'm doing something wrong again. That's not credit. That is, what am I trying to say? 1475.08 of our cost base. Alrighty. We could have added it back in here on the short calls, but I just did it here. So either way. All right. Next step is coming back to our history here. We sold those. We made a good amount. If you're just going off the last one, we made about 97 cents, 98 cents, whatever it is. And if you're doing both of them, we had netted all 13.23 or so. Excuse me, 223 of credit. Excuse me, 312 or something. And we used all of that credit and bought triple the amount of contracts on our long call position to dollar cost average and lower our cost basis. So let's do that part. Sorry guys, if this is elementary to you, then I apologize, but I kind of feel like it helps to go through and just show exactly how things work. So 1475.08 is our cost basis. And now we're going to add up all of our 180. We went and bought let's see, how many did he buy? Well, he has 20, so I assume he bought 16. So he pretty much tripled his investment. Go back to the history. I don't know why it's not showing 16 more in here. That's weird. But knowing, let's see, this might help us. Sorry guys, trying to kind of go off the cuff. Here it is, 16.30 for 34 cents. So it costs 34 cents. Let's do some more space here. For 16 more. To triple down on our long calls. So 34. And 16 contracts, that represents 1,600 shares, because we know our contracts, of course, represent 100 shares. So $0.34 times 1,600, $5.54. Even, right? $5.54 even is what it cost. So we bought $0.34 per share. All right, and then we're going to add that to our other original long call, our other cost basis. So 1475, 8, plus the additional 544 equals, not plus, get back our calculator, plus 1475, 8, 2019.08. And then we're going to take that number, total cost basis, let's say, and divide by all 20 contracts, or on a per share basis, 2,000. And that leaves us $1 and almost a cent. That's what we need our contracts to be worth to get to our break even. So if you look back on here, it's aggregating everything right here for $1.47 and saying our cost basis is, but it's not subtracting out the profit we had from our short calls, which pretty much all went to buying triple the amount of contracts from 4 up to 20 and lowering our cost basis down to $1. per share. So, whew, you know, adding, subtracting could be so arduous. So going back, just to go over the math, we have $1 per share cost basis. That means we need it to get back up here to $1 to our break even, and it's trading at 32 cents. Well, that doesn't sound impressive until you remember cost basis was on all those long calls way up. This 842 per share plus this 358 per share, almost $12 per share, minus 440 or so, 445. So about $8 per share, all the way down to $1. I'd say that's pretty cool. And that is how you lower your cost basis so that you don't need it to go up so far, and see if we can't make this trade successful. We have out until September, if you remember, and that gives us another earnings to go through. Hopefully get things to bounce back. It gets us through the summer, where a possible trade agreement could happen. And if that happens overnight, Baidu will shoot up like crazy and we'll have some decent profit there. In the event that it drags on, or we're kind of getting close to September and nothing's happened, and their earnings just kind of was mediocre or what have you, whatever the case may be, I think that you have to remember that we can always take our current cost basis and add to it to roll out for more time if we need to. Obviously, we can say it comes up only a little bit. We can add some short calls back on, lower our cost basis even more. We can, there's a couple of options here. I got a question. Oh, I got a comment. If it doesn't happen, we take vacations in China. Good idea. I'm going to go with you on that. Doesn't happen. We're all just going to go take a trip to China. Although I heard Bali is much more entertaining and friendly. But to each their own, Abraham. Good idea. Are there any questions about what we went over here? What do you guys think? This is a waste of time. This is freaking amazing. I think it's pretty cool to take our cost basis down from 8, and really could have been 12 if we just gone long calls, right? $8 per share. All right, a couple more questions. Abraham asked, use a spreadsheet to make it easier to calculate cost basis. Sometimes yes, and it is easier. And if you do have E-Trade here, it does have this little thing. I don't know if you can see it out to the side, but this little download thing that gives you a spreadsheet to go off of, but or just a regular calculator work sometimes too. So thanks, Rich. It is important to understand. Helps me see the possibilities for correcting a trade gone in the wrong direction. Of course, and that's what it's all about, because that's what options give us. Options give us options, and I've talked about that a couple of other times on times I've been on, and Kevin seems to scream that quite a bit, and it's great because it's true. It gives us an ability to manage the situation and give us a better chance of being profitable. Yeah, it's way down at 30 cents per share on those 180 long calls, but it's a hell of a lot better than being way up at 8, and that could be fantastic profit in a very short amount of time. I mean, Baidu moves. When it moves, it really kicks off. So there you go. I did want to go over a FCX that I had gotten asked about from a client who's listening, and I'll leave their name anonymous just to be kosher. But I thought this was kind of cool going over this. This is our Baidu chart again. Let's go over to CX. So we had a client who has been in FCX for a period of time. When it was going up, it was a protection on collar trading of shares. Not sure how much shares. I'm guessing around 1,000 originally. Protecting for earnings, protecting for events. Came at kind of a cost as things go up, of course. Protected at $14 per share, came down to 12. Cashed that in to buy another 100 shares, it came down to 10. Cashed in 12 puts, 12 puts to buy another 100 shares, so 200 shares extra in FCX. Just from collar trading, that's 200 more shares. That gives us more dividends. That's 200 more shares. That lowers our cost basis. Smart client added 200 more shares to his position by collar trading. And investing the Warren Buffett way, or as Andy Dwyer calls him, Warren Buffet. If you caught that reference, I'm proud. If not, I'm sorry. That's 200 more shares with dividends, which certainly over time is going to pay for all those times we had to just pull puts off for a smaller loss, try and save some money as the things went back up and whatnot. That's dividends that are, paying you instead of going off and buying a mutual fund that's really just kind of taking everything. That's 200 more shares, as I said, to lower our cost basis. Well, everyone has to wait. Oops, to get all the way back up to 14. That's pretty cool. And it's all about building shares. With our collar trading and with our calls, long calls, and bull call spreads, it's about lowering our cost basis. That's how you do it. Obviously, shares never expire. They just, you know, give us some dividends. We can hold them. We can be passive as we want to in our shares. And when things drop and we can catch some of it, that lowers our cost basis. And if we catch enough of it, we can add more shares, further lowering our cost basis and giving us more returns as it goes back up. That's what it's about. So, there's the stock market gets kind of a bad name, and much of it is warranted, of course. It's kind of crazy. But, there's not a lot of other places you can do this kind of thing. Have this much availability to protect our investment or a trade like a bull call and lower our cost basis, buy more shares or contracts to make things successful going forward. So there you have it. If you guys have any other questions, throw them out right now, but that's all I had for you. Give you a minute to think it through. Of course, we can go back to Bayou if you have any questions with that. But all we're doing is basically taking our short call profit that pretty much completely paid for, not pretty much, totally paid for, all 16 more contracts of Baidu long calls at 180. I'll write that in. All right, you're welcome, guys. Thanks for listening in. If there's no other questions, I think that's it for me. And thanks for joining me, and we'll see you next time.